So, Quito, thanks for being here. And I've been emailed and by call by so many of my friends about loan mod, short sale, and I wanted to bring an expert here today and that you share to all my viewers basically what's happening in the loan mod and all the most common questions being asked right now. Okay? But before we jump into the question, tell me and the viewer who you are and what do you do?
Okay, well, my name is Quito Keutla, and what I do is basically help people stay in their home through doing loan modifications.
And what did you do before this? You know what I mean? So you have lots of experience about loan mod.
Right, before this, I was in real estate, got involved in real estate in 2002. So for the last 7 years, been doing real estate, and in the last 2 years, really been doing short sales. And finally, getting to loan mods, it kind of became natural. Instead of helping people sell their home short, now it's like figure out how we can keep people in their home.
That's right. That's great. So first of all, let's start off with this question: what is a loan modification, and how is that different from refinancing?
Okay. Well, a loan modification is basically changing the terms of the existing loan. Okay. Versus getting a loan refinance on your loan, meaning you basically, the value has to be there, so you would have to get an appraisal and basically go through the regular loan process to get a refi, and then you have to qualify.
Right.
With a loan mod, the great thing is they don't care what your credit score looks like. So, and in terms of the value of your home. So
how do someone qualify for a loan mod then?
Well, basically, the banks look at a couple different factors. One is the hardship, and hardship could be, well, did they lose their job, or has their hour been reduced? If you're self-employed, has your income been reduced? Or did you get divorced? Is there death in the family? Did you increase debt over the years? So they got to look at, what is causing you to have a hard time making your mortgage payments. Not everyone will qualify for a loan modification. That's why it's really important to look at the financials and see what is going on.
So what would cause someone not to qualify for a loan modification?
Well, if they're not having a hardship, if they make too much money, and if right now if they owe more than $729,000 on their home, it would they would not qualify under the new program.
And so when someone do a loan mod, what does the bank actually do? Do they actually drop their interest rate? Do they extend the loan out? What do they do?
Well, the bank will actually reduce their interest rates. Okay. So for example, if someone's paying, say, 8% interest on their loan, it is possible to have the banks drop it down as low as 4%.
Wow.
And I've seen some cases where we've done where they've gotten down to 2% interest rates for several years. And sometimes it's for several years, sometimes it's fixed for the life of the loan.
Right. Do they actually extend the loan also? I mean, where does all this extra payment that was the different, where do they go? What did I do?
Actually, the difference in terms of payment, yes. The borrowers are not responsible. They don't have to pay the difference.
Okay.
So they just basically, it's like getting a new loan.
Okay.
In fact, it's better than a refi if they're in a situation where they're having a hard time making their mortgage payments.
Right. And so what are some of the determining factor that a lender is actually looking for?
Okay, for the consumer, what they're looking for is one, their debt to income, and also two is the ratio in terms of how much they make, their gross income versus their housing income. And what the banks is looking for, if you exceed like 31% in terms of, if someone's making $4,000 gross income per month, right? And their mortgage is $1,400 per month, right? Someone like that, because what they bring in is exceeding 31% of the ratio.
Right.
So that the front end debt to income.
Does someone have to be behind in their mortgage to actually qualify?
That is not necessarily if we could prove that there is eminent possibility of the owner defaulting. But however, most of the clients that I do work with, they're either several months behind on their mortgage payment. I had some as, hasn't made a payment since August of 2008.
Wow.
So, it varies, and just in the brink of foreclosure, and they get referred to me, and all panicking because their home's going to go in foreclosure a week.
Right.
So I take their information, present it to the bank, and actually able to postpone the foreclosure and hold it so we can work out a way for the homeowner to stay in their home.
Right. Now, is there any negative on doing a loan mod to the individual or to the property?
Well, for the most part, I don't really see any negative in terms of a loan modification, because one, you're really helping the consumer stay in their home, versus losing their homes. Because oftentimes, even though the home may have a negative value from when they had bought it, but the thing is, if they are able to stay in their home, obviously they get the benefits of the tax write-off, and they're not having to go and rent. Because oftentimes we could modify it to where what they would have paid in rent, they could actually be living in their own home.
Right, right. So, some people, come to me and say, man, I don't want to do a loan mod. I'm scared I mess up my credit.
Mm-hmm.
Right? And then they hesitate on doing it, but they're also facing foreclosure.
Right.
What would you say to that person?
Well, you know what? Loan modification would be, a great option to look into, because chances are, if they're already behind on their mortgage payment, face foreclosure, their credit is already shot.
That's right.
Okay, and having a foreclosure in your record has much of a greater impact than having lates on your credit report.
That's right.
And I've read somewhere that it could have up to about 200 points in terms of credit score of how foreclosure impacts your credit score.
Right.
And in terms of a loan mod, I mean, you're looking at maybe 60 to 80 points difference in terms of your credit. And usually within 2 years,
Right.
You can get your credit back up to good standing if you continue to make your mortgage payments and be responsible for your other debts as well.
That's right, I agree. So here is the last question, and this question here, I get asked all the time. Why should I pay for a loan modification expert when I can do it myself and save the money?
Mm-hmm. Right, I get that question a lot.
Right.
And it's like anything else, because a loan modification, it does take 90 to 180 days
Wow.
to get approved. And one, it's really time consuming in terms of, one, you got to gather up all the paperwork. And if you're out there working a 9 to 5, you're spending most of your day trying to earn money to make the mortgage payments, right? And we know this way with an expert, one is we know what the banks are looking for. We know how to talk to the banks in terms of what to say to them, how to write a letter that's going to really help them get approved.
That's right. That's great.
Yeah, and even though there is a lot of nonprofit organization out there that is, helping the consumer with loan modification, but oftentimes a lot of those people, they don't have the real estate or the mortgage background to really understand what the banks are looking for.
That's right. That's a great point. Well, Quito, we really appreciate you being here today and sharing your knowledge about loan mod. And I actually look forward on doing a lot of visits with you in 2010 and in the future.
Great. Well, thank you, Thach. Pleasure to be here.